Right now, the pound is standing on a cliff edge, and almost nobody is talking about the real danger. While everyone watches the dollar index, pound sterling to US dollar is quietly building a bearish structure that could trigger a 200 pip collapse in the next 48 hours. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use now, including a sniper short that targets the 1.32 handle. This is not a drill.my session bias for pound sterling to US dollar right now is bearish trending, but we are approaching a critical floor that will either hold and create a massive bounce, or snap and accelerate this sell-off. The one invalidation level that proves this bias wrong is 1.3548. If the bulls can reclaim that resistance, the entire daily structure shifts from strong sell to a potential reversal. But I don't think they will. Write this number down. 1.3386. If we break and close below 1.3386 today, this pair enters freefall mode. That's the line in the sand. Here's what most traders miss about this setup. The market is treating 1.34 as a number, but the real battle is between 1.3386 and 1.3383, a razor-thin zone that holds the entire trend together. I'll explain why in a moment, but let's dig into the charts, because this is where money is made or lost. Starting from the top timeframes and working our way down, because the monthly chart is screaming one thing, and the daily is screaming another. The monthly trend is a strong buy. No doubt. We've been in a structural uptrend from the 1.2000 region, and that big picture context tells us that this sell-off is still a correction until proven otherwise. But here's the catch. The weekly chart is now neutral. The momentum that drove this pair above 1.3800 a few weeks ago has completely stalled. The weekly candle is forming a bearish engulfing pattern, and that's a warning shot that the correction has further to run. Now flip to the daily chart. It is a strong sell. Price is trading at 1.3430, well below the daily moving averages. The 5-day exponential average is at 1.3451, the 10-day at 1.3462, the 20-day at 1.3469. All of them are above us, acting as a descending ceiling. The 50-day simple moving average is at 1.3474, and the 100-day is at 1.3454. Look at that compression. All these averages are clustered within 20 pips of each other. That is a dynamic resistance zone, and it is heavy. Every time price rallies toward it, sellers step in with size. Now, the 200-day moving average is sitting at 1.3383. That's the only major support from a moving average perspective, and it's only 47 pips away from the current price. This is why the zone between 1.3383 and the key horizontal support at 1.3386 is the ultimate battleground. The next signal changes everything when we look at momentum. The RSI on the daily is 46, below the 50 center line, confirming that bearish momentum has control, but we are not yet oversold. That means there is plenty of room to fall. The MACD is at negative 0.0000, essentially a dead cross right at the zero line, which means the trend is primed to accelerate lower the moment we get a catalyst. There is no bullish divergence, no hidden strength. This is a textbook bearish continuation setup, now drop to the 4-hour chart, where the execution will happen. The picture gets even uglier for bulls. We have a series of lower highs and lower lows, the classic definition of a downtrend. The 4-hour MA20 is at 1.3460, sloping down and capping any intraday bounces. The MA60 is at 1.3490, aligning with the daily resistance cluster. The MA200 on the 4-hour is way up at 1.3550, so the short-term trend is firmly bearish below all three. The 4-hour MACD is deep in negative territory, with no sign of a bullish crossover, and the RSI is at 42, confirming that sellers are in charge but not yet exhausted. On the 1-hour and 5-hour charts, both a strong sell, with the 1-hour MA20 at 1.3445 acting as the immediate resistance. So intraday, we have a full alignment from the daily down to the 1-hour, a rare, clean bearish cascade. Here's a detail most retail traders ignore. The volume profile shows a high volume node right at 1.3500, which makes that level a magnet for any short squeeze. But below us, the next significant liquidity pool is way down at 1.3200. That means if we lose the 1.3386 to 1.3383 support zone, there is very little structure until the 1.33 handle and then 1.32. That is a 200 pip vacuum, and when price enters a vacuum, it moves fast. The daily support and resistance levels for today are crystal clear. Immediate support is 1.3420, already tested this morning and barely holding. The must-hold support is 1.3386. Below that, it's open air. Resistance starts at 1.3501, with a secondary ceiling at 1.3548. Those are your boundaries. Now, let's connect the news to the price action because the fundamental driver is the real engine behind this move. The headline from the last 24 hours says it all. Pound treads lower as hawkish tide rises around it. What does that mean in plain terms? Over the past week, we've had ECB officials making surprisingly aggressive statements, hinting that another rate hike is possible before the summer to crush sticky inflation. At the same time, Fed speak has been uniformly hawkish, pushing back rate cut expectations further into the second half of the year. But the Bank of England? The BoE has been much more cautious, with recent minutes showing concern about the fragile UK housing market and consumer spending. The message is clear. The BoE is likely to cut rates sooner than the ECB or the Federation. This policy divergence is the engine driving pound sterling to US dollar lower. The pound is losing its interest rate advantage, and that's a fundamental shift that reprices the pair. Look at the euro to pound sterling cross. It has been climbing steadily, breaking back above the 0.8600 level and holding there. That tells you the euro is outperforming the pound, which means dollar strength alone is not the full story. Sterling weakness is real and measurable. When you have a hawkish tide from the ECB and the Fed but a hesitant BoE, the pound becomes the weakest link in the G10. The crosslink here with euro to US dollar is critical, and this is where the dollar killer narrative fractures. Normally, euro to US dollar and pound sterling to US dollar move together against the dollar. But right now, euro to US dollar is holding up relatively better because the ECB is talking tougher. If euro to US dollar breaks below its own key support at 1.0700, that would amplify dollar strength and accelerate GBP or USD's decline even more. Conversely, if euro to US dollar rallies on a dollar pullback, pound sterling to US dollar might still struggle to participate fully because of the relative underperformance. So we are in a scenario where sterling is a sell on any dollar strength, and only a marginal buy on dollar weakness if the BoE sentiment shifts dramatically. Over the next 1 to 2 weeks, my directional lean is firmly bearish, targeting 1.3200. The exact event that would invalidate this thesis is a break and daily close above 1.3548, or a surprise BoE communication that shifts hawkish. Until then, the path of least resistance is down. Most people will skip this next part, but this is where money is made. Keep watching, because I'm about to give you 3 precise trade plans that map directly onto the levels we just identified. But first, let's see how aligned we are. Type your pound sterling to US dollar range for tomorrow in the comments right now. I am reading them, and I want to see if you see the same boundaries I do. The most accurate ranges often come from the community, so drop your high and low. Strategy 1 is the sniper, the conservative approach. This is for those who wait for confirmation and refuse to anticipate the break. We are looking for a bearish breakout and a close below the key 1.3386 support on the 4-hour chart. The trigger condition is simple. A 4-hour candle closing below 1.3380. We want that margin below the 200-day moving average and the support to filter out the false breaks that hunt stops. Once that candle closes, you enter short on the immediate next candle open. Your stop loss goes 5 pips above the breakdown candle's high, but I cap the maximum stop distance at 30 pips from entry. So for an entry around 1.3375, the stop would be at 1.3405, which is just above the broken support now acting as resistance. That's a 30 pip risk. Target 1 is 1.3300, a round number and a previous structural level, giving a risk-reward of 1 to 2.5. Target 2 is 1.3210, right at the next volume cluster and a measured move from the consolidation range. That pushes the reward to over 1 to 5. This setup is voided if price fails to hold below 1.3386 within 2 candles and snaps back above 1.3420. At that point, the breakdown is a liquidity grab, and you step aside. Strategy 2 is the active trader, the standard mean reversion play for those who don't want to chase breakdowns. This one uses the moving average cluster we mapped earlier as a dynamic. Resistance zone. The entry condition. Wait for a pullback into the 1.3470 to 1.3480 zone. That's precisely where the 50-day simple moving average and the 4-hour MA60 sit. Look for a clear rejection wick on the 1-hour time frame, ideally with RSI spiking above 60 and then curling down, showing the moment the selling pressure resumes. Enter short at 1.3475 with a stop loss at 1.3510. Just above the daily resistance at 1.3501. That's a 35 pip stop. Target 1 is 1.3420, the immediate intraday support, for a 1 to 1.5 risk reward. Target 2 is 1.3386, the main battleground, giving approximately 1 to 2.5. Once target 1 is hit, move your stop to break-even and let the remainder run toward the key floor. This is the safer, higher probability way to sell into strength without trying to pick an exact top. Let's pause for a moment. If you're finding these levels useful, type the number 1.3386 in the comments to confirm you're tracking the same line. Seeing that number repeat in the comment section tells me you're engaged and ready for the next move. Strategy 3 is the Aggressor, a high-risk countertrend long for those who thrive on catching falling knives. This setup bets that the 200-day moving average holds and creates a violent snapback rally. Entry condition. On the 1-hour chart, if we spike down exactly into the 1.3390 to 1.3385 zone and immediately see a massive bullish rejection candle with a long lower wick, combined with RSI dropping below 30 and then rebounding hard within the same candle, you can go long. Entry at 1.3395. Stop loss at 1.3370, just below the 200-day moving average and the key support, a tight 25 pip risk. Target 1 is 1.3440, the 1-hour MA20 resistance, and target 2 is 1.3475, the top of the mean reversion zone. This is a quick scalp against a dominant trend, so if the bounce does not materialize immediately, you exit without hesitation. This strategy comes with a clear warning. Only for those who know how to lose small and manage risk aggressively. If dollar strength accelerates on a hawkish Fed headline during the session, this bounce will fail fast, and you will be stopped out. No exceptions. This takes 30 seconds, but it saves accounts. Never risk more than 1 to 2% of your total capital on any single trade. Avoid holding positions through high-impact UK or US economic releases, including the services PMI due tomorrow. Stops are non-negotiable. Mental stops do not work when cable drops 100 pips in minute. Put them in the system, and walk away. So here is your one critical level for the next session, 1.3386. If we lose it, the bearish floodgates open and 1.3200 becomes the magnet. If we hold it, this correction may finally find a floor, and we will see a sharp short squeeze back toward 1.3500. Tomorrow, the UK services PMI release will be a major volatility event, and I will be back with an updated plan covering all 8 key assets. But right now, if you want the full breakdown on euro to US dollar and how the dollar index is driving everything, that video is live on the channel. Check the end screen now. Smash the like button if this analysis gave you a clear, actionable plan. Subscribe and hit the bell for daily coverage. I'll see you in the next one. Now go manage your risk, and let's trade this properly.